fueled by roaring financial markets and historic housing valuations. Less than a year later, $17 trillion in wealth had evaporated, and 30 million people were out of work. This catastrophe was a man-made contagion, engineered through the deliberate choices made inside one specific institution. That institution was Lehman Brothers. Founded in 1850, it had survived the Civil War and the Great Depression to become the fourth largest investment bank in the United States, acting as a cornerstone of the modern financial system. Because of its age, its massive balance sheet, and its Wall Street pedigree, the global market operated on the fatal assumption that Lehman Brothers was invincible. As an investment bank, Lehman functioned as a high-capacity financial engine, raising the capital required by massive global corporations and foreign governments. During the early 2000s housing boom, Lehman adopted a highly aggressive strategy. They drove their revenues sky-high by trading new, highly complex financial products linked directly to residential real estate. This chart shows Lehman's market capitalization from its public offering through 2008. You can see the explosive growth firsthand. Their valuation surged from $5 billion in 2000 to over $40 billion by early 2007. But that record-breaking wealth was not built on actual cash sitting in a vault. It rested on a precarious foundation of hidden, highly volatile debt. Lehman made a fatal operational pivot. Instead of just brokering mortgage-backed securities to clients and collecting a safe fee, they decided to aggressively buy and hold these assets on their own books to capture all the potential profit. To keep the profits flowing, Wall Street required an endless supply of new mortgages. They began relying heavily on subprime lending, handing out high-interest loans to uncredit-worthy borrowers who were highly likely to default. Buying up those subprime loans required cash, which brings us to leverage. Leverage is the practice of borrowing vast amounts of money to gamble on an asset, hoping your returns easily outweigh the cost of the loan. Lehman took this to the absolute extreme. By 2008, they had leveraged their assets up to 44-to-1. That means for every single dollar of actual stockholder equity they possessed, they borrowed $44 to buy more toxic mortgages. That math carries a death sentence. At 44-to-1 leverage, if the housing market dips and the value of their assets drops by a mere 2.5%, the entire firm instantly becomes insolvent. Their actual equity is wiped out. Lehman's executives had engineered a multi-billion-dollar financial empire entirely dependent on the assumption that the most financially unstable Americans would never miss a mortgage payment. In 2007, the housing bubble burst. Mortgage defaults skyrocketed across the country, rendering those underlying securities essentially worthless. The ultimate red flag arrived in March 2008, when rival investment bank Bear Stearns nearly collapsed from the exact same real estate exposure. That should have triggered an immediate, massive retreat across Wall Street. But Lehman's management, led by CEO Richard Fuld, chose to double down. Instead of liquidating their toxic real estate assets and accepting the losses, they kept buying, convinced the market would rebound. This chart tracks Lehman's stock price in blue against its default risk in red. Notice the red line violently spiking upward in 2008, proving the internal market knew the firm was decaying. To hide that reality, Lehman used an accounting trick known as Repo 105 to temporarily move $50 billion of debt off their books right before reporting public earnings. This toxic combination of immense leverage and deliberate deception burned through Lehman's actual daily operating cash. They were fast approaching a terminal liquidity crisis. By Friday, September 12, 2008, the clock ran out. Lehman Brothers owed a payment of $5 billion, but they only had $1.4 billion on hand. They did not have the cash required to open for business on Monday morning. An emergency gathering was convened at the Federal Reserve Bank of New York. The top CEOs of competing Wall Street banks were summoned to hammer out a private rescue plan. But the government delivered a shocking ultimatum. Treasury Secretary Hank Paulson drew a hard line, declaring there would be no taxpayer-funded bailout for Lehman. Throughout Saturday, a desperate attempt was made to sell the company to the British bank Barclays. But by Sunday morning, the deal fell apart when British regulators vetoed the transaction. Out of cash, out of time, and abandoned by the government, Lehman's executives had no other options. They were forced to draft a bankruptcy petition before Asian markets opened for the week. At 1:45 a.m. on Monday, September 15th, a 150-year-old financial titan was allowed to die. It became the largest bankruptcy in U.S. history and pulled the pin on a systemic grenade. When the sun rose on Monday morning, global stock markets nosedived. As panic spread, $10 trillion in stock market value began to evaporate worldwide. Because Lehman was deeply interconnected with thousands of derivative contracts and overnight loans, nobody knew which bank would fail next. Trust vanished, and banks globally stopped lending cash entirely, even for routine business operations. The credit freeze hit Main Street almost immediately. Healthy businesses couldn't secure the short-term loans needed to make payroll, triggering mass layoffs. Those lost wages triggered a massive wave of residential mortgage defaults. Behind the plunging numbers on the trading terminals were millions of broken lives. Families lost their homes, their jobs, and their life savings as the global economy plunged into the Great Recession. The collapse leaves a harsh, enduring lesson for anyone managing money. If an investment's returns seem too good to be true, they are. And no matter a firm's historical prestige, you have to understand exactly what risks they are taking with your capital.